Everybody that's following Build-A-Bear seems to really love this company, and over the last month, as of the recording of this video, it's actually up approximately 20%. So the question is this a company worth buying at the moment? I'm going to investigate that in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel. And this is what's really interesting about Build-A-Bear. In the intro, I said that everybody is in love with this name, and this is what I mean. I have a subscription to Seeking Alpha. That's the OG of the investment space, and it's very interesting. I like to look at like the rating summary for a company that sort of comes across my radar, and this one was very interesting because it's got very high ratings across not just Seeking Alpha authors, not just Wall Street, but also their quant system. So it's worth looking into. And notice that over the last month, since the recording of this video, the share price is up approximately 20%. So this name is really gaining momentum over at least the last month. But notice that over the last year, so year to date at least, the stock is still down. Early in the year, it was trading as high as $22 per share. So it's still down approximately 7%. But based on the current trajectory, you could see it surpass that price. Now, I know that there's a lot of people that watch this channel that are not necessarily from North America, and you may not necessarily have a Build-A-Bear where you are. Well, this is what it looks like. It's basically just a store in the mall, and you walk in and you can build a custom bear. So it's a very interesting and fun thing to do. I'll definitely do it with my kids. And they don't really have a real competitor. So from a moat perspective, this is a really interesting, unique business. However, it is a very consumer discretionary type purchase. So if we're entering an environment where spending is going to be tighter, inflation is still raging, and interest rates are going up, this could be the first thing that families stop buying. So be very careful in this environment with an investment like this. So buyer beware. And as you can see, the average price that the analysts have on this is $33 per share. And I think it's just one analyst that's covering it right now. So that's a 75% upside according to analysts. Now, I always say on this channel that I always pay attention when the upside is higher than 50%, because what those analysts are giving you is a price target for 1 year out. So if they believe that the stock is going to go up more than 50% in 1 year, it's worth paying attention to, or at least investigating to see what's going on. But one thing that I always point out is, guys, it's very important to model out these companies and every opportunity that you're going to invest in, because it's important to see what the story is, and you'll see sort of intricacies of what's going on that could help you value the company out. And this is one of those situations. And so from here, you can see that the average cost of goods sold as a percentage of revenue is 56%. But notice in fiscal year 2021 how COGS dropped to 47%. So the question is, can they continue this strong trend going forward? Or will their gross profit margins decline back into the mid to high 40%? I guess the average is probably in the mid 40% from 53%, which is where it was in 2021. So that's a big question. And the best place to look to have that question answered is how are they doing in fiscal year 2022? So up until today, they've only released first quarter earnings, and you can see that gross profit margins remain at all-time highs, and SG&A is running very low, and in fact it's running lower than the 40.6% that it ended off at in fiscal year 2021, which was a record. And so at 37.1%, it's very interesting that the company is even more profitable thus far in fiscal year 2021. But like I mentioned before, this is a very consumer discretionary industry. These numbers could turn around real quick. So the question is, how should we think about profitability going forward? Now, once again, this is a model that the Patreons get access to. So my question is, do they maintain strong margins or does it reverse? So scenario number one is saying that they maintain strong margins. But so with COGS, I'm just increasing it a little bit to around 50% and forecasting that out. And so what does that give us? Well, you can see that if they maintain or slightly decline with their current margins, this is a fantastic opportunity because it's valued at approximately $34 per share with a low terminal multiple of approximately 15 times earnings. So it's trading at approximately 56% of its intrinsic value. So that's very interesting. Now, the second scenario is, do you think margins can go back to the historical averages? So I would assume that the cost of goods sold as a percentage of revenue is approximately 55% historically. And so this is what I would consider scenario number 2. So under this scenario, if their margins return to historical averages, then this doesn't really look like an attractive opportunity. I'm valuing them at approximately $18 and they're currently selling at $19. So the share price as a percentage of valuation is appropriately valuing the company. And note that in the valuation, you did see a little bit of excess cash. And the reason why you're seeing that is because they have a very clean balance sheet, no debt, and they have excess cash. So that's why you're seeing a bit of a bump in the valuation. Now, guys, one thing that I do want to point out is that approximately 80% of the viewers of this channel are not subscribed. So if you can get an opportunity to, please consider subscribing to this channel so you don't miss out on great content. And the question is, where do I fall in terms of the valuation? And I'm having a lot of trouble sort of thinking about where this lands. I think I'm going to wait another quarter before I consider even purchasing this name. I think if the share price goes down considerably, if I can buy it at something really low where it even makes sense if the margins decline, then I'm more inclined to buy that. That was kind of what I did with Crocs, where the share price was low enough that even if the margins declined and the company started earning returns that were much lower than previously forecasted, it would still be generating at least like a 10 or 15% return on my purchase price. And so that made a lot of sense. In this situation, it doesn't make a lot of sense yet with the current share price, but if the share price went down to 15 or 10, it'd make a lot more sense. So I'm willing to wait and just see how this plays out. I want to know what management thinks about their margins going forward. So in Q2, I'm going to read the transcript and see sort of what they think. Now, you guys let me know what you think that margins are going to roll out at over the next couple of quarters and the next couple of years, and how are you valuing this out? Now, the best place to start with your valuation is take my model and look at it and see sort of what the inputs are at every level, and that will help you decide where you get to. Now, how do you get access to that model? Well, you can get access to that model and all of the other models at the lower tier of the Patreon. And if you want access to an epic live presentation every month, you can join us at the upper tier of the Patreon. Now, I did mention Crocs in this video, and I recently just put out a very interesting video on Crocs, which you can actually get access to right here.